Hey, my name is Keith Hall. I'm a CPA. I work with small businesses and have for over 25 years, helping small businesses just like you. You may have a question today about estimated taxes. Do you have to pay estimated taxes? Now, interesting answer to that question. In fact, no, you're not really required to. But if you don't, it's going to cost you. So I answer that question a little bit tongue-in-cheek because certainly you should make the estimated tax payments that you're required to. The key point is the IRS has a pay-as-you-go system for taxes. Now most people, employee types, have somebody to take care of that for them. Their company withholds tax out of their paycheck and sends it to the IRS on their behalf. But small business owners, those like us, don't have anybody to do that. So we have to keep up with the pay-as-you-go system by making estimated tax payments. Now those payments are due 4 times a year: April 15th, June 15th, September 15th, and January 15th. Basically 4 equal payments. Now the real question about estimated taxes is how much should your estimated tax payment be? And that's really the difficult part. The real answer is you should make enough in estimated tax payments to make sure you avoid all IRS penalties for late payment of tax, because that's where it gets really expensive if you don't make those deposits. So the IRS knows this is tough to estimate, so they give us a couple of get-out-of-jail-free cards, if you will, safe harbors in avoiding those penalties. The first one, and this is the easiest one to remember, is if you pay in enough in your estimated tax payments to at least equal what you paid last year, then no matter how much you owe or how much you make, you won't have any underpayment penalties. So you've got a copy of last year's tax return. You know exactly what the total tax was. Now this is not what you had to write a check for, it's the total tax on your tax return. You know what that number is. And in estimating next year's tax payments, take that number, divide it by 4, send that amount in each of the 4 quarters, and even if you make $100 million, you'll still have no underpayment penalty. So that's the easiest safe harbor to look for. So in a year that your business is growing, you expect to have higher earnings, therefore higher tax. That's a great strategy for estimating your payments. Now keep in mind there's some discipline needed there because you're going to have to write a check on April 15th because you've made more money. But the good news is you've kept that money all year rather than send it to the IRS too early. Okay, now the second get-out-of-jail-free card that the IRS gives us is if you pay in at least 90% of what you end up owing, then you'll have no penalty or interest. And that's kind of like they recognize it's an estimate, so as long as you get close, it's okay. So if you end up paying within 90%, now that's a little more difficult because you don't know what that number is going to be yet. So you need to take out a piece of paper, take out a pencil, and do a little bit of math. Use last year's tax return kind of as a guide. You know income is going to be a little bit different. Maybe you lost one of the customers that was your big customer last year, or maybe you were out sick for a couple of months, so your earnings are going to be lower. Take that last year's tax return, estimate what the income is going to be, look at the expenses. Some are going to still be there, some may be lower. Do a quick estimate and kind of like a pretend tax return for the whole year. That'll tell you how much you think you're going to owe. Take that number, divide by 4, and those are your 4 quarterly estimated tax payments. Now when you get to the end of the year, as long as you've paid in at least 90%, then you'll have no penalties or interest. Now that piece of paper that you've done the math on, keep that in the desk drawer somewhere. Great idea to take that back out halfway through the year, or maybe in the 4th quarter of the year, and look at your guesses again. Maybe you need to change some of those guesses. Maybe the year was better than you thought it was going to be, or maybe it was worse than you thought it was going to be. But just because you do the calculation once doesn't mean you can't change that. So it's a great idea to reevaluate that estimate as you go through the year. Now there's one other kind of a safe harbor that the IRS gives us, and that is if you end up owing less than $1,000 at the end of the year, then there'll be no underpayment penalty as well. So that's also another one of those kind of get close. Now you may also be asking, how do I make the estimated tax payments? Well, as you might guess, the IRS has a form for that. The form is IRS Form 1040-ES, relatively easy to calculate or to fill out. You basically have your name, address, your Social Security number, your spouse's Social Security number if you file a joint return, You put the numbers over to the right on the form right there. In the instructions to the Form 1040-ES, depending on where you live, it'll tell you exactly where to mail the form along with your check, and you'll be in great stead with the IRS on your estimated tax payments. So remember again, not really required. Nobody's going to call you and remind you. You're not going to get an email from the IRS telling you to send them a check, but you need to remember to make those payments, because if you don't, it works out being a relatively expensive loan from the last person you want to borrow money from, which is the IRS. So hopefully that helps you with your estimated tax payments. Keep up with those, and when it's time to file your tax return on April 15th, you'll be much happier that you did. Thanks for watching. Don't forget to check out the links above and the links below for more detail. Also, make sure to rate, comment, and subscribe. If there's something else you would like to see, just let us know. Email us at request@mahalo.com.